Much has been said about how fragile and short-lived defensive rallies tend to be. How critical are the signs coming out of Japan, and where can we find value out here in Asia? Let's pick up on these topics with Catherine Yeung, Investment Director of Fidelity International, and Joseph Incalcatera, HSBC's Asia-Pacific Economist. Welcome.
Morning.
So we're seeing outside falls in both dollar yen and Japanese equities. As more we find out the details about Japan's stimulus package, is this a no-brainer? Was it a given, since much of it was in line with expectations?
Well, it seems to have disappointed many investors, but the whole Japanese situation really does reflect what we're seeing across asset classes, and that is there is an abundance of liquidity. This liquidity is trying to find a home, hence why the bull strategy versus the bear strategy, they're all working in tandem.
Your house view is that Japan will probably load up on more ETF purchases, but probably won't let the helicopters take off in their September meeting. If that is the case, how much flatter can JGB yields go? And where is your dollar yen target then?
We think that means they're going to consistently kind of come short of what markets are expecting. So in terms of dollar yen, we actually see the dollar falling to 95. And again, for yields, they can only go in one direction as the BOJ struggles to kind of meet investor expectations.
We just heard the RBA cutting rates. Which other central banks do you think will offer looser policy?
So in North Asia, we see China, Taiwan, and Korea all delivering more easing. And then in ASEAN, basically most economies, Malaysia, Thailand, Indonesia, and in India and South Asia are all probably going to be delivering easing. Ultimately, monetary policy has limits. So ideally, we'd like to see more fiscal policy where possible. But all we really see is Korea and Japan delivering some type of supplementary budget this summer.
Yeah, so you've got, from your investment perspective, a whole silver platter of countries that are coming up with looser policy. Where would you be a buyer?
China, for the second half of the year. So because China's still been out of favor versus many other markets, it's likely that the market will play catch up. And importantly, when we look at China, some of the heavy rains we saw in May and June actually saw a lot of the infrastructure projects being delayed. So you're going to see a pickup in infrastructure projects. You're also going to probably see the NPL, so non-performing loans, the debt restructuring situation, be less aggressive or less severe, which will ease investors' concerns about the whole growth story in China.
How do you play the markets? China has been an underperformer for much of the year. Post-Brexit, it actually outperformed most markets. But right now, we've got fresh concerns about tighter regulation and the renminbi, IPOs. I mean, the list goes on and on.
It does go on and on. If we look at, for example, the things that one needs to monitor closely, it would be confidence in the private sector, so CapEx. The consumer base still spending, the property cycle has done very well, but you're likely to see tighter policy. But don't forget, property is the backbone of the economy. And then finally, state-owned enterprise consolidation, corporate governance transparency, where the President Xi Jinping can implement all the policies he's been talking about. But at the end of the day, they have the tool set in terms of easing, policy maneuvering. We're still seeing a number of interesting companies, and it is an emerging market. And from a global perspective, only about 2% of MSCI, when we look at revenue, is exposed to UK and Europe. So you could actually see more Chinese companies acquire offshore companies at an attractive price.
Chinese PMIs show some signs of stability. How much can they be affected by external factors?
But a lot of this ultimately boils down to inventory restocking, and we're not really seeing a boost in external demand. Based on export data and new export components of the PMIs. There's some room in China for growth precisely from infrastructure like you were mentioning, and it's the great thing with China is that the government has sufficient policy tools such as increasing the fiscal deficit, such as a sufficient scope for monetary easing to offset some of these external headwinds. So that's why, in a sense, China can be a bit more resilient and why we've seen growth hold up.
And Catherine, before we go, you talk about this catch-up play in China in the third quarter. Percentage terms, how much of a bounce are you looking at?
Well, it's likely to at least come back to, it's very much one of the worst performing markets, so make up for that initial loss. But, you know, again, potentially, it's all stock specifics. One should look for identify companies that can still grow, that has good market share. For example, you know, some of the big players, the big internet players who have, you know, whether it's Tencent or Alibaba, yield so important, and some Chinese companies pay some very, very attractive yield.
All right, great stuff, guys.